Hi, welcome to Zero Fucks Given. My name is Krista DeLuca. You're here with my wonderful boss, Carson Block.
Esteemed.
Whatever. And Freddy Brick. And we had, what?
I'm not your boss either.
No. All right, just.
We'll go.
That's not how the budgetary process works yet. And who's our very special...
Hugh is our very special guest. How are you?
Fantastic. Thank you for asking.
And by the way, he's Hugh Hendry.
Hugh Hendry, I'm sorry.
All right. So you were going to ask me to give a little background on Hugh,
Please.
right?
Yes, absolutely.
Okay, cool. So I've known Hugh for several years, and you used to run Eclectica, which was a global macro fund. And then you moved to St. Bart's, and you were on Twitter. And now I just stumbled across this YouTube channel where you're in the bathtub in Paris.
Yeah.
And so I guess my top of mind question is, what are you doing now? What's going on?
Hey, Carson, it's rock and roll. It's finance rock and roll. I'm now on a permanent tour I'm ricocheting between LA, Venice Beach, St. Bart's, Paris, and London. I would like to dismiss any rumors that I have been incarcerated. You do see me in less than humble surroundings. I did not touch anyone. I was not carrying any product for anyone. You happen to find me in a hotel room by the airport, not of my choosing, but sometimes international travel is like that. But to answer your question, I have moved one step further forward to the edge of the abyss. I am a financial raconteur. I discovered with the closure of my hedge fund that the thing I miss most wasn't investing other people's money, but it was the showtime. It was having an idea and wishing to subject it to the ridicule of others. And so that is what I am fully engaged upon now. It's remarkable that without a Bloomberg, without paid for stimulants, there's maybe something in the Wi-Fi, but when it mixes with my tour of duty, my experience, my filters, what can I tell you? Like today, I can see dead people.
Wow.
Oh, all right. Well, I do just want to, I think,
Wow.
put one important caveat out there.
You seem kind of boring compared to this fucking guy.
I am. I mean, he's in like 4 places in 1
shit.
week. He's in
Why isn't Hugh here with us?
Because Austin's not on the St. Bart's, Paris,
Oh.
Venice, beach, something else
Circuit.
itinerary.
Yeah.
Circuit.
But I'm hearing about, what's that funky place in the desert, the art scene?
Burning Man?
Burning Man?
No, I mean, it's not Texas. Or is it? No, that's
No,
California.
no, it's not.
No, the Martha,
Marta.
Mara, they are. Should I go
Yeah.
there? I'm hearing that it's got a good vibe.
Yeah, I went there. It's I don't know. I mean,
what?
Whoa.
Huh?
what?
Every
What?
Monday, I come in, I'm like, oh, hey, how was the week? And you're
Dude,
like,
I had to-
played with the dog and yada, yada. You, went to the desert and did mushrooms and didn't tell us?
Yeah, well, you guys, I'm on a different level. I'm here, and you guys are here.
Where's Hugh?
Still trying to understand that.
Hugh's up there.
Okay, so
Anyway.
all right, so
Yeah, I mean it's fine. So Marta is originally where the first, I believe, Prada store was. Prada.
in the middle of nowhere, Texas.
Yeah, actually it is. I swear, you can look it up. You can look it up.
That's how you
It's
know
true,
a
and
country has no history
It's
when
very.
when the oldest thing there was a Prada store. That is
It was like the
literally,
first Prada store.
that is
okay?
the sign of how shallow and lacking of depth a country
And
is.
so now it's
when the
more like
first
an
Prada
artist
store is
community.
there.
and
Okay.
stuff, and I stopped there.
All right.
It's
Well,
nice.
that's cool. I want to hear about dead people. So Hugh, what are the dead people and what do they want?
Well, I feel like I've seen the silo of the missiles kind of move over onto the launch pad and the steam come out, and I've watched them depart. And these aren't missiles. This isn't Elon going to Mars. These are missiles of financial destruction, which are going to rain upon us. I believe they've been launched. I'm unsure as to where they will land first, but I know we're now in motion, and I am getting ready for and fearful of impact.
Okay. So what are the particular missiles that you're talking about?
The particular missiles really are the consequences of the chauve-souris. Chauve-souris is the French for a bat. A bat is commonly thought of as being blind. The French, with their sophisticated language, the literal translation of chauve-souris is a bald rat. So I think of central banks as being bald, rat-like, and blind. And normally I can just ignore them and filter them out. But they are insisting on playing what I deem to be a very reckless and inappropriate game of raising interest rates in a recession with debt levels of between 4 and 5 times the size of the global economy. And they're using the benchmark of the famous, talk about Martha rather, the 7-foot Texan in the 1970s, when he did the same thing, except he did it at the end of a 40-year cycle of deleveraging and not a 40-year cycle of leveraging. And to assume we would have similar results, I think, is foolhardy. And so I fear their tinkering and their blindness could have significance of a magnitude of at least 2008.
Okay, because that's what I was going to say was 2008. If you describe these as macroeconomic missiles or policy missiles, in 2008, the system was really pushed to the brink, and it still held. So it's hard for me, to be totally honest here, it's hard for me to get that there's really a recession. I think there are a lot of contradicting data points as to whether there is a recession. For years leading up to 2008, I had expected the housing market to implode and the leverage in the system to become a massive problem. But I don't see anything like that right now. I do feel like this is, while there certainly can be, policy errors that lead to high levels maybe of corporate defaults. I don't know, what am I missing in the, not seeing the Armageddon?
Well, you're not seeing impact. You're not seeing impact. And I speak both in hyperbole and with profound uncertainty. I don't speak with certainty. I'm speaking of things that might happen, and I'd ask you to contrast that with policymakers who talk of definite things, that we're definitely not in a recession. Language and the nuances of language are keys which sometimes unlock some subconscious thinking and allow me to get the glimpses of the future. The absolute determination of the Fed to resist the classic definition of a recession being 2 consecutive quarters of contraction. It's 2 consecutive quarters of contraction. It is not qualified by the degree of contraction. It's the first time in my career where I've ever seen it challenged as not being a recession. And then this notion that we should wait for the wise economic council. Tell me, you know better, what is the private organization which is charged with determining the economic cycle?
So we're talking the Fed here, or the national, the NBS, National Statistics.
Yeah,
I think
NB blah blah blah. Yeah.
Yeah.
If you look at when they, again, there are other chauve-souris, when they wake up and they go, yeah, it's a recession. Typically, the S&P is down between 30 and 50%. So good luck awaiting the official confirmation. Too late. So you can't see anything. The Indian rupee is collapsing. The Chinese currency is now on its biggest drawdown versus the dollar, annual drawdown versus the dollar, annual calendar year drawdown almost ever. Yeah. You have this energy crisis in Europe, which is demand destruction. You have a central bank which, on top of the profound demand destruction from the energy shortage, is raising interest rates to what? To destroy more demand. You have the Japanese yen at 25-year lows, and the significance of that, which is perhaps not as obvious to others, and I'd like to expand upon that. You have the sovereignty of Europe now being questioned, not by its assimilation of different cultures and politics and what have you, but by the fact that consistent political folly has left it without a perpetual source of energy. And I believe sovereignty is related to energy, to being able to source, with energy is certainly my joy, but I don't believe you're a sovereign without a sustainable, independent source of energy. So, I mean, we could spin that bottle and take one of them randomly. I'd be happy to. But, you start adding all of them up, and it's quite considerable.
Well, you talk about how previously when such large hikes happened, we were in a deleveraging cycle and we're in a leveraging cycle. I mean, isn't this time to bring an end to the leveraging cycle? Isn't it time to deleverage? Because, and if you say, well, look at all these bad things that are going on, it'll never be the right time. But I mean, really, what seems to have happened since Volcker took those actions is that the debt in Western economies has piled up to enormous levels. You referenced that, and every time that becomes a problem for us, every time there's a macroeconomic near catastrophe, whether it's the internet bubble, the housing subprime bubble, then COVID, the cure for too much leverage has been more leverage. I mean, to an extent, we're reaping what we've sown, I would think. And yeah, like there's never going to be a good time. And I really do question whether Powell has the actual balls to really try to break the cycle. I don't think he does, just based on how Trump pushed him around into rate cuts that were completely unnecessary in 2018. But yeah, isn't this the medicine we need?
Well, there's a danger in being puritanical. There's a danger in being the Andrew Mellon Secretary of the States and demanding that we purge the system. I lost the calendar years of 2009, 2010, 2011, demanding what you're saying now. Bring it on. Having seen the excess, having seen the errors, having seen the politicians come to understand that the situation was perhaps beyond their means to rectify, and then beginning to ban truth-telling via short sale bans, etc. I wanted to purge the system of its rottenness. And I was wrong then. And I think you would be wrong today because of the profound misery that you would be imposing on ordinary folk who've already endured a very mild form of depression. And so to put on that hair shirt, I think you would actually be bringing forward a moment where the political system might reject market-based economics. So, and I would say to you that there's nothing, bubbles are sustainable. They're kind of inglorious, but they're sustainable as long as debt is serviceable. The folly today is they are messing around with the sustainability of how the economy can sustain the debt.
Well, I guess so there are two major pushbacks I've got right there. And this is, again, philosophy of whether this is good policy or why do or do not pursue further hikes. But number one, it's almost as though previous policy error is too big to fail. I mean, to to me that seems completely unacceptable. And maybe I'm oversimplifying things, or you said being too puritanical, but how can we have compounded policy error become too big to fail so we don't mess with it? Number one. Number two, you brought up the political element, but even during the relatively sanguine days of pre-COVID, there was still growing inequality. I mean, look at the rise of right-wing populism in Western countries during that time, since the financial crisis. And I understand 2009, 10, 11, 12, probably too early to pull the rug. But since then, if things were great, how and why do we have this explosion in right-wing populism? I mean, maybe it could get worse, but I think inequality has a lot to do with it. And certainly the owners of financial assets who, in many cases, if you're just long house, some stocks, I mean, you haven't really put in effort to get wealthier. If they suffer losses, that might actually be somewhat of a politically stabilizing, societally stabilizing event.
Yeah. So I don't know. I did at the time, and I had to recant. And the errors of my judgment again, 2009, 10, 11, I think led to the demise of my hedge fund ultimately in 2017. In March 2009, Citigroup was trading at, let's call it $7. Maybe it was $9, which was the same level as prevailed in 1977. But it was overstated. The true value was zero. It was bankrupt. And back then Citigroup was kind of like the JP Morgan. It was like the dominant banking franchise. It was bankrupt. And the Fed was forced with that, the redux of the early 30s. Does it stand aside and listen to me and purge the system of its rottenness? Or does it intervene and prevent the bankruptcy of the American banking, the global banking system? And it intervened. Now, it did not intervene on its own. It intervened as an agent on behalf of every citizen of every nation. And therefore what that meant was that within a nation, there is the disenfranchised. And by that, I mean those who have the misfortune of youth, wisdom, or lack of, or utility not to own assets. And they had to underwrite and bail out those more fortunate that owned assets. Okay? And the problem is they've had to do that again and again and again. And that, as we know, that gap has only widened. And I think it ferments the political right wing, or the kind of the polarization within our political economy. So I believe the Fed was right to make that decision. If I was to criticize the Fed, it would be the purported and it would be the attempts to raise interest rates in 2013 and 2015 and 2018 that I reject, because they were raising interest rates within a depression. We had never retained the growth rate of 2.8%. We had got nowhere near it in 2013 with the shadow tightening of quantitative tightening. We weren't there when Janet was trying to raise rates just a tiny bit. We weren't there when the first incarnation of Jay sent markets down 20%. That's my. We're tied to the fact that they had to bail out the system. Okay. Now, on top of that, there is a really, really, really complex thing going on in terms of the explosion in asset prices, and I believe the culpability of that rests with principally the Chinese, but let's say with the mercantilist economic policy, where you outsource demand creation. And you do so by a kind of vendor financing. We'll build it, but we'll finance it, right? Here's the money, you spend it, we'll build it, okay? The Chinese do not trust their citizenship to have a consumer boom. They don't believe that the CCP don't believe that that their political economy could have withstood the economic ravages in North America of 2008 or of the years 2000, 2001, 2002, or the 1970s. And they believe there's the responsibility for the economic vicissitudes on the economy is these silly consumers. And so they drive, there is an institutional format which is long in the tooth, which creates surplus savings, which they transport to the US via the purchase of US Treasury bonds. And in total, we're talking $7 trillion. And it's like, it would be wonderful if America was in the 19th century and you were building canals, you were building multiple railroads to the same destination. We were rolling out telecoms and building chemical plants, you name it, right? It'd be wonderful. Because back then there was a deficit and America was borrowing from the rest of the world. America's domestic spending needs are well serviced by domestic supply. This is the surplus savings thesis of Bernanke from many, many years ago. And what that does is it crushes interest rates. And with that discounting mechanism, you send asset prices of the least risky businesses to infinity, and you transform an industrious society into one that is reckless in the pursuit and vulnerable in the pursuit of speculation.
A lot to unpack there. That does remind me of a book I read some years ago by Duncan. Can't remember the last name, but it's talking about how current account surpluses or massive current account surpluses, like in Japan in the 1980s and in Southeast Asia in the 1990s, have led to the inflation of assets and asset bubbles. But let me throw it over to you guys. Like, where do you stand on this?
Yeah, it's nice of you to punt it over to me after Hugh sounded smart and we're not macro guys, so maybe 30% of that went in. But you bring up China, Hugh. You were quite opinionated on China way back when. Lots of people had the yuan trade on. Where do you think China goes this time? Because it does actually look like things are really, really bad on the ground there. And this idea that they could slowly let the air out the bubble does not seem to actually be the case. We're seeing widespread refusal to pay mortgages. The shadow banking is unwinding fast. And I think what's really interesting for me is when you look at the controls that were instituted on Chinese people during COVID, specifically with like the COVID kind of reporting on their phones, China is unsurprisingly using that as a form of population control on top of the pretty aggressive surveillance infrastructure they have. So when you see people deciding to go out and protest and they're pissed off, that's a pretty heavily weighted decision, because it's not like, hey, I'm just going to join a rally, no one knows I'm there, maybe I post it on Facebook. That is like, I'm putting my fork in the ground that like, fuck the CCP. Like, I am really pissed off that the home equity in the 15 apartments I own is worth nothing and I can't sell these things. And my life savings, my parents' life savings, probably my grandparents' life savings have all been funneled into that. So I don't know if we're necessarily not as aware of what's going on in China, or if it's just hard to actually get a real handle on what is going on in China because of the sensitivity to information leakage. And on top of that, you now have Xi, who is clearly jostling for power as he's about to position himself as ruler for life. So what do you think happens? Is this the time when it all really does implode in China? And how does that actually impact the world outside of China, not just from a commodity purchasing perspective, but actually interlocking trade with the rest of the world?
Well, the U.S. listed Chinese companies will still report record revenue and
Record
profit
revenue,
growth.
yeah, that'll have
But
no bearing on Alibaba's just up and to the right growth.
My thing is, I'm damned by China and by the euro, because it would seem that I've been a perpetual pessimist with regard to those two areas. If I may, with regard to my culpability, my point is that there has been a religious cult-like belief in the euro, the sanctity of the euro, and the Chinese economic model, which led to the pricing, the almost certain-like pricing of some macro instruments, whereby I could choose to speculate and say, I don't believe. And the penalty for being wrong was boring, but it wasn't a penal execution. There was convexity, however, if I was right. And on the several attempts with those trades, the timing was out. With regard to China, I was out by 10 years. I had a blow-up fund 10 years ago. Now, I laugh about this, but I'm kind of a little bit taken by, I'm a time investor. And like I've said, I think, Carson, we were talking about this, I'm going to keep this short, but the calibration of time is somewhat different in China. Like the what do you call it? The astrology, the heavenly motions. For us, it's the rotation of Earth around the sun. Obviously, that's 1 year. The Chinese system is 10 years. 10. If I'd added 10 onto my thesis 10 years ago, it would take you bang into today. Yeah. So tongue in cheek. I think it's the real deal. But then many would say, you said that the last time. Tell me this: where do you value Chinese real estate? What $1 trillion number do you put on it? You guys would know.
well, I'd have to check. Wow, how many tabs is that model? About 150.
We keep adjusting.
Yeah. No, so the short answer is we wouldn't know, but unfortunately, but getting back to that, and something that you said earlier about Chinese consumer and consumption, I've long had this theory that when you've looked at the growth of household consumption in China, at least through several years ago, it had compounded at 8% a year from 2000 onward. And so I felt that rather than saying, oh, well, Chinese household consumption, it needs to come up because it's only 45% of GDP, it should be at 60 or whatever it is. I felt like really the way to look at this was the inverse. And this was telling you that since the household consumption was compounding at a healthy pace, this was telling you how much waste there was really in fixed asset investment in China's GDP print. And that was, I think you probably got, by this measure, probably would have gotten to 35% of China's annual GDP being what I would say is excess value destruction. Because obviously in every economy, there is some level of value destruction, but relative to what one would expect, and maybe it's 35%. So household consumption actually never really was that disappointing. So if you take that view, which no serious economist I've ever put this to has taken that view, or like given me the time of day, or even not headed right to the men's room as a polite excuse to end the conversation. Take that point of view, that would tell you that perhaps the value of real estate in China is, especially the built real estate, is significantly lower than where it's been marked.
Yeah, but the high mark was approaching 90 trillion on a 15 trillion economy.
The Spanish are looking at that thinking, God, we really could have gone much harder. Why were we so limp dick on that?
Yeah. Well, because nobody ever said Spain is growing really fast.
Except the Spanish.
I don't know, man. They're not under the
There were
illusion.
there were some Irish banks that thought Spain was growing fast.
But I would even argue by that same logic that I presented that $15 trillion overstates the size of the Chinese economy.
No, it does. And so, I mean, again, it all relates to the aftermath of the great financial crisis, that to sustain or to find itself committed to these preposterously unnatural high rates of GDP growth in the aftermath of 2008. And clearly there was a rebound in the West. Clearly we went on to establish new nominal and real GDP highs in the rest of the world. But again, the rebound never took us back to trend. And so each year below the prevailing trend, if you will, was a deficit year. And therefore was a deficit year that had to be made up. If you're committed to the historic growth rate, it had to be made up. The gap had to be made up by a new contribution to GDP growth. And that gap, which you, I think, correctly alight upon as being about a third of total GDP, was made up for by a residential property bubble and fixed capital formation. You know, the construction, let's say, of high-speed rail, whereby the nominal cost today of it would never be recouped from the utility function of moving people from one conurbation to another, because when the GDP per capita is, say, $5,000, and you're moving them to another conurbation where it's $6,000 or $7,000, but the rail links cost you $10 billion. Those people are not in a hurry. If those people were on $70,000 and you could take an hour out of that journey, the utility, the social utility would far exceed the $10 billion of the construction, whereas it was always the reverse. And so it was phantom GDP. Phantom GDP is GDP which does not add to wealth. And so the lie in China, I think, which you guys identified very early on, was that the GDP was never substantiated by the stock market because there was no wealth created.
That being said, when they built the high-speed rail, I want to say off the top of my head, it was like 200 billion or maybe more, that kind of project. It was a great excuse for graft. I mean, how much of China's nominal bridges to nowhere, roads to nowhere, was just a really convenient excuse for graft? And that money has ended up here,
right,
more than anywhere else. Maybe the city of London, Canada,
and pushed up the values of real estate globally.
Yep.
But yeah, I mean, the Ministry of Railways was at one point in time easily the most corrupt part of the entire Chinese government. The amount of money stolen from that, and reminds me of that company that we looked at years ago. It was listed in Hong Kong called Tibet Water.
Oh yeah,
and this was beautiful, because the problem when you rip off a bunch of RMB is how do you move it offshore? So that's what you need to launder it, basically. Well, Tibet Water seemed to be theft and money laundering built into one. And so what Tibet Water, it was a company that made bottled water. And nominally, the retail price of it was in China was a decent bit higher than that of Avion. But its only customer was the Ministry of Railways, which gave it away for free on the trains. So basically...
And because it was in a really remote part of Tibet, they built the track to extend out so they could literally like turn up and pick it up, which was like a good way to graft money on that end and on that end.
Yeah. But the best part is it was real money that was being paid by the Ministry of Railways to Tibet Water, which created an actual value for the stock that paid dividends. It was in Hong Kong. So it was basically in a fully convertible currency at that point. So that's how it was theft and money laundering built into one. The powers that be, basically they owned, I'm sure, shares of Tibet Water. They collected the dividends, they sold the stock, all while it was getting paid onshore by the Ministry of Railways for, what was probably water with, some level of like urine in it or something.
Yeah, no, I remember that one in particular. I was working on the IPO. It was super hot. Like everyone knew it was super hot, and no one really knew why it was super hot, but everyone knew it was super hot. Because you're like, yeah, water, and you're kind of like back enveloping it, and you're like, okay, maybe they can actually produce that much water. And I think it was the American club or the China club. I'm sat there, and I look young now, as you frequently remind me, but I looked really young then. And I think the chairman was so bothered by the fact that someone like so young and inferior was placed in front of him at the China club that he took my business card, he drew a picture of my face on, and then just gave it back to me at the end of the meeting.
Way.
Yeah, it was true, like China chairman. We're really just here to do a bit of shopping and hang out with our mistresses while we kind of graft some cash. And he gave it back to me. I should have kept it.
Was it a good picture of you?
It was not bad for a guy who had a ballpoint pen and like one of those kind of like slightly perforated cards that wasn't that easy to draw on. It was not bad. Yeah.
Okay. Well, evidently he'd spend some of his excess cash on some drawing lessons or something like that.
Yeah. I'm not sure he had much else to do at the Ministry of Railways. So Hugh, I want to pick up on something you were talking about earlier, how you'd been bearish for a while on a few things. And we were discussing earlier macro fund management and how it is the greatest asset class because it basically means here's the money, do what you like with it. And I had two questions. My first question is, why are all macro guys bearish? I'm yet to come across a macro fund manager who's telling you, stock market's about to go up 6x for a good reason. Maybe they'll tell you like hyperinflation is going to cause it to go up 6x, and then they'll reference the Zimbabwean stock market. But like, is it just like dropped on our heads like that? What kind of confluence of things leads you to macro and then bearish?
I kind of want to push back a little bit on the macro being the best. Macro back in the day was the highest honor, like to be granted the mandate to do macro was almost like being appointed, being appointed 007, to have a license to thrill, that you were unconstrained. You could do anything, just not lose money. Okay. Whereas every other Muppet was in a silo and their behavior was strictly regulated. You must do this, you must not do that. The macro manager was like, I have so much admiration for your skill set, entertain me.
That's
okay.
Why no one's ever pitched us on doing a macro fund.
Now I'm talking 15, 20 years ago, and the world reined that in. Okay. Now, secondly, in the reining in and the pigeonholing, but when it was not family offices and entertainment, and it was, I'm going to give you $100 million minimum. It became one of, how do you fit into my portfolio? And macro became, you were long volatility. You were charged with developing an independent series of returns, independent of the beta that was fueling the global economy or the global financial marketplace, because you were not benchmarked to one thing. So what was like the greatest asset that you could be ubiquitous actually became the hardest thing, because it denied you the beta, which has made many a hedge fund manager billions of dollars PA, especially in the year 2020, 2021. I was a macro manager at the end of 2013, and I wrote to my clients and I said, what if I was, I was paraphrasing Entourage. What if I was to tell you that I had turned bullish and that the most likely path for the S&P was higher and higher and higher? Is that something you'd be interested in? And my team and the CEO who'd come in and repackaged us and taken us from $50 million to 1.5 billion said, if you press send on that, it's the end of the franchise. And I pressed send, and it was the end of the franchise.
Carson, if we're ever in a situation that is remotely similar or even close to that AUM, I'm going to chop your finger off before you're allowed to. And you're going to hold him back.
Dude, I'm going to chop both his hands off. What are you gonna do?
Yeah, but I'm thinking like I don't need that. Like I'm, 1.5 billion. I wouldn't fuck with that. Like that's a great job to have. But okay, so basically you're saying that what ended up happening was macro managers were paid to bet to bet basically not in line with beta, maybe against beta in some ways, because you're in allocation in somebody else's book as opposed to somebody who's got a very large diversified book. So de facto everybody became bears in global macro. That's what you're saying, yes?
Yeah. And you were long volatility, and you spent your time finding uncertain convex return structures where the punishment of being wrong was not career defining, because of the pricing. But I believe the Ministry of Transport is more responsible for the elevation in the S&P than quantitative easing. Okay, but where I would fall in with the consensus and central banking and quantitative easing and financial assets, I think without a doubt, quantitative easing systematically brought volatility down and therefore destroyed the macro community between the years 2011 and 2020. They were systematically long volatility, and each year another central bank joined the fray, and each year volatility fell lower and lower and lower across all asset classes.
So my question is, lots of macro fund managers have lamented how destruction of volatility was just a nail in the coffin of that strategy. And was there no appetite to say, look, fuck it, you have money with me, which can be massively short vol. We're going to go as far out and biggest piece of shit we can find out, the furthest out on the curve, and we're just going to own boatloads of it because that's actually pretty non-consensus among the other macro managers that you have money with.
I disagree. That everyone else was. I don't think they were necessarily doing it consciously, but like being heavily leveraged and heavily short vol was the unconscious go-to place. And therefore, if you volunteered to participate, then what was your role in a portfolio? You were just like the other guy. It led to my eviction. Now that, and the folly of my personality, whoever I am and whatever, but that's another story. But and I'm not playing a violin and saying la di da. I'm just trying to give a historical account of that time. And then every year there would be the sales mission would be, this year's the year for macro. And it's just like, you said that last year. You said that last year. You said that last year. Yeah. And I'm not going to say it, but central banks, if a macro strategy played out when central banks really assed up, and for the last 15 years, they've been pretty tight, and macro returns have not been there. But they're really assing up now. And I am not volunteering to be a global macro manager. I'm not coming back and entering the fray. I'm happy being a raconteur. But my God, if global macro cannot make a fistload of money in the next several years, then it should be abolished as an asset class.
When I think of global macro managers, I think of a guy in London. It's like 5 drinks in by the end of lunch, tons of leverage.
Still in business.
Still in business.
Yeah.
Does this sound like one person I'm describing, you, or like a dozen?
It sounds like one person that certainly I was aware of. Not me, heaven forbid.
How much does the mark-to-market play a part in disrupting a thought process in macro? Because in short selling, it's incredibly painful, and our risk management process is much more focused on getting out the way of a speeding train than being heroes and being like, we held it to zero and it went up like 10x, and I was convulsing under the desk, but we were there in the end. Like, that's just not our approach to risk management, and for some people it is. You obviously have constructed
5 drinks by the end of lunch would help. Not convulsing under the desk, you're just riding it out.
Macro, obviously, in the trades you've looked at, you generally are trying to construct trades with much more convexity, which equity guys suck balls at, and it doesn't necessarily always lend itself to convexity. So how does writing it out and the mark to market and the pricing instruments really fall into how macro management works versus how you might trade your PA with a similar thesis?
Well, and corollary question, since the financial crisis, there's a lot less liquidity in the CDS market.
Right.
That obviously was where you got all the convexity in the subprime trade. So how much did that impact your life as a macro manager, just when the CDS market wasn't what it used to be?
Well, just right there on the subprime. I was a big believer in the underwriting pen pressed at your spine, and that if you eased up, boom, the dagger was touching your skin, sort of thing. Keep focused, yeah. And so, but back in 2007, we either had bi-monthly or monthly. There was a point we ran half of the life of the fund was it was weekly, and then we moved to monthly. In March of 2007, we had Deutsche Bank's Greg, whatever he's called, Mr. MBS, camped out in our office in London because Deutsche Bank, he wasn't welcome, and signed up for the trade. And this is literally, you've bought, something bad's going to happen, and you've bought 1 million damn Hershey chocolate bars or Wonka bars, trying to find the golden coupon to visit the factory. And we had found it. We're like, yeah, okay. And we start putting into the portfolio. And the custodian bank based in Dublin, I think we're almost certainly having 5 very large, tall glasses of Guinness at lunchtime. But they came back, and there was a degree of legitimacy. But they came back and they said, these instruments are a bit funky and they're a bit new, and we're not sure as to the mark, how reliable the mark is. And as your custodian agent, that's a problem for us because we make a market in your NAV. And if we're not confident, then we can't provide the liquidity in your fund. And I was like, get out of here. What? And we had to take the trade off. Can you imagine? We had to take Charlie's bloody golden invitation and put it in the bin. Can you imagine that?
Find a new custodian.
Yeah, like you must have had the shittiest custodian in like all of hedge fund world. I have not heard that.
The communication was via facsimile.
Oh, they might have been the most advanced custodian in Ireland then.
Oh my God.
But imagine going to your clients and saying, had a bit of a disagreement with my custodian, Frank, and fired them. And I found this new group with a better answer. You might need 5 glasses of wine to pull that one off, So, and in return, what happened? It loaded us with complexity. You had liquidity on the other trade. We had to create, and it was simple. Forgive me. It was kind of binary. You were right, and you made a lot of money or went to zero, right? And we had to construct something convoluted in fixed income with options and forward options, forwards on forward. I mean, just in doing so, we created something which had no negative carry, but it left you the victim of a very the journey was literally the air conditioning wasn't working. It had been raining. It was cold outside, and your breath was heating up the windscreen, and you kept going, "Are we there yet?" Sort of thing, And the return finally came literally at midnight. Like what is that? 16 months or 14 months or whatever of like, oh, and then boom, we got home. So. I don't know if I've answered your question. I've answered it certainly with an anecdote, which kind of just, not only do you have to find the damn trades, not only do you have to give great, almost more precedent to the journey, it's almost easier to identify the outcome or the destination. It's harder, and you have to be really alert to the dangers of the vicissitudes of the journey there. And with experience, I'd almost say the greater the convexity, the more challenging and circuitous the route to point B will ultimately prove. So, I mean, that's just called experience.
And were banks just more willing to create these highly complex structures? We're quite familiar with the process of phoning up a counterparty with an idea to which we already know the answer is no, and they'll just carefully explain how they get to no.
Well, but I'm sorry to take that question out of the answer out of Hugh's mouth, but I would point out that yes, because banks are a lot more regulated now, they can't take the other side of the trade. So I would think there's a lot less they're willing to do.
But there's always either Korean retail or private banks, right? Where like that stuff all kind of trickles and sits eventually, or Credit Suisse.
I mean, I'm not sure how much shit risk you can lay off, because usually I think the shit risk they lay off into the private banks is the underwritings done by the investment banks, right? Like the shit bonds and things like that. So, to take the other side, like some structured product that some hedge fund wants to put together.
That trade, like hey, we've got a smart hedge fund that wants to do it in synthetic, like cat's out the bag on that. I got to assume a decent amount of that equity vol like sits in those structured products, probably in private banks. I know, Krista, I'm also dying to know about forwards on forwards. We'll probably have to Investopedia that.
Yeah.
But yeah, I guess my other question is, in your interactions with banks, did you have those tense moments where they were phoning up and bitching about collateral as the whole world was falling apart, or was it actually quite scenic? You were just kind of sitting in your office, click a few buttons, everyone goes home, has dinner, or was it this like moment before Christmas as you described it?
Well, again, if I go back to the instance of 2008, which you have to, because we came within a heartbeat of the global financial system going bankrupt. I had a client that had the wisdom and the kind of network, the wisdom to know that something wasn't right, a desire to find a hedge, and the network to be sent to me. And they got an amazing deal because they came in like I was small and they were big, and so they got 50% discount on everything. And they'd come in, I want to say December 2007, January 2008. And I had a fault in my system in that, and I'm embarrassed to say it today, but there you go, I will. We had, again, this is in the context. When they came in, I was $100 million. I had one PB, Morgan Stanley. And they came back over the summer and they were very upset about having one PB. And by late summer, no one was going to take you on, clearly, and certainly not at 100 million size. And they were from all over the world, but I remember being summoned to an Italian restaurant in New York. And they said, we've got a guy, and he's down 30% on the year. Now, I was down 3. So 3-0 versus 3. And he said to me, he gets it. So I was like, okay. What does he get? Because I don't want it, but and they fired me. And like I was like, I'm sorry, hold on a second. Like the earth below me is moving. I'm sitting on a geyser. I mean, say that again. You want your damn money back, you bloody idiots? And I stood up. I was like, you are morons. I remember the what you call the napkin hitting the guy's forehead and bouncing off. I was like, I'm out of here, right? And Lehman's happened. We made our having waited for the best part of 13, 14 months, we made all the money in like 3 days. And we had half the fund to redeem. And as I had said during the persistent due diligence, we are the liquidity. They have to escape the damn trade. They were on the phone hourly begging for us to take it off. And that's how it played. And maybe it helped having the fact that I had to liquidate anyway. And we made 50%, in the worst financial calendar month in 100 years, we made 50%. And you would think that would be legend making, perhaps as a rock and roll star, but not as a macro hedge fund manager.
Does making money like that, like in the one shot, does it take the edge off just gradually chipping away? I mean, the way we work, it generally boils down to a few decent ideas a year, and there's concentrated risk around those events. And when it goes really well, there's a relief, actually. That's the overriding sense. When it goes better than expected, there is like a rush of adrenaline and a feeling of satisfaction. And it's it's not like scoring the winning goal in the FA Cup final, which it's nice that I have someone on finally who will get that reference, because it's obviously lost on you.
Yeah, it might as well be the Robbie Williams Cup. I have no idea what you're talking
Hugh,
about.
you know who Robbie Williams is, right?
And the FA Cup, yes.
And does it take the shine off buying a piece of real estate, levering up 3 times and coming back in 5 years and being like, oh, I made some money doing that?
Well, funnily, you should say that. The most spectacular investment returns I've ever made have been from St. Bart's Real Estate.
Okay, so Krista was telling us that you're pitching St. Bart's Real Estate pretty hard, but I didn't.
Yeah, he's got to get out the trade. He's the liquidity.
What's that Irish custodian bank doing? I'm not pitching it. I mean, it's but you asked the question, and and you mentioned I didn't have that. I should have had more leverage on that trade. I haven't. It was the wrong way around. I'm somewhat fearful of that. But I think there's something about I am sure I'm making this up, but there is some kind of story that with the first engagement of my parents with a teacher, parents' evening kind of was lovely child, but for one so young, my God, he worries. And I want to say I found the perfect role that compensated me for the worry. I was going to worry anyway. I mean, I discovered in St. Bart's, I would worry about the pernickety, stupid details of the color of the serviettes, the towels on the the sun loungers, as much as I'd worry about the composition of the damn portfolio. I am designed to worry. And thankfully, I found an engagement whereby at least I was rewarded for my persistent and skillful worry set. And so within that, I find that the losses, there wasn't that natural symmetry that purportedly explains life, pain and joy. I find it more asymmetric, but arguably that says more about me than it says about the financial markets.
It's all very familiar.
Jesus
We're
This is your
we're
twin.
worriers and lamenters.
Yeah.
Over here. Cool. Well, Hugh, it's been awesome catching up, man. Really appreciate you reaching out, and I would love to see you. Please add Austin to the World Rockstar circuit that you're on, or tell me.
I want to say I'm coming because I've got a collaborator, John, who arranges all of these engagements, and he's from right on the Texas border, the Mexican border, and it was him that was telling me about Marta and things, and I think I'm definitely I'm coming.
All right.
I'm coming.
See?
I'm coming.
Okay, cool. I mean, I probably won't do the desert thing myself. That's more of a Freddy thing. But...
Listen, when you're the acid capitalist, you got to do the shrooms, you know.
You don't have to leave the city to do that.
Yeah, but you got to gaze at the stars and like, get down with the nature.
Actually, I got to tell you, when I've been on shrooms, it's been so hard to leave the hotel room. Like, I just get super freaked out.
Paranoid.
Yeah, it's like 10 attempts to leave the hotel room before I'm finally able to do that. So, yeah. But anyway, I'll figure it out. If you come to Austin, we'll figure something out. I'm
coming. Well, thank you all for the spirit of the bon vivant spirit. Much appreciated. You've cheered me up in this box that I find myself interred in for the evening. So thank you.
All right. Well, as I've told people before, if you come to us for the upside, like things aren't going so well. Yeah, things clearly aren't going so well, but hopefully that will turn around.